Hi, Tony here, Senior Market Analyst at IG Australia. US stock markets dived on Friday due to escalating tariff concerns and signs of stagflation within the data, which included weak consumer spending, slower growth, and hotter than expected inflation. Looking ahead, investors are nervously awaiting the April 2nd Liberation Day tariff deadline, hoping for some clarity on President Trump's tariff plans. To recap, we have existing tariffs on the following after a lot of going back and forth and headline news. There is a global 25% tariff on steel and aluminium. Trump has increased tariffs on China from 10% to 30%. This week, we're expected to see the 25% tariffs on autos kick in on April the 3rd. We're also looking for the paused 25% tariffs on USMCA compliant goods to commence this week. Now, the new tariffs which we're expecting include the base case of an average 15% increase across all US trading partners, which will potentially be reduced to 10% through negotiations. Under Trump 2.0, tariffs have been faster and broader than expected, and that's causing most analysts to revise their forecasts for inflation, the US employment rate, and recession higher. We're also at the same time seeing them adjust lower their forecasts for GDP. This puts this week's PMI data, Fed Chair Powell's speech, and of course, the non-farm payrolls report on Friday night firmly in the spotlight. Let's take a look at the charts of the S&P 500 and the NASDAQ to see where they are as we start the new week. All right, so in the sell-off from mid-Feb to mid-March, we saw the NASDAQ break through some very important support levels, the 200-day moving average, which is the orange line, and of course the uptrend, which went all the way back to December 2022. With some of the easing in tariff rhetoric, which we saw up until late last week, the NASDAQ was able, like other global equity markets, to commence a rally, but the rally stopped short of the 200-day moving average. And there's a real reason why we have this 200-day moving average on the charts, because it is just so important for stock indices and FX markets. The rejection from this 200-day moving average has the NASDAQ eyeing this 19,152 low from March. And the best guess is after coming all this way back down towards these March lows, we see a break. Now, in terms of how far the break goes, there is a good level over here from September coming in around 18,806. So that's probably the area where I would be looking for any sell-off this week to come down towards into this 18,800 area. And then after that, we may see a bounce, because you could also say that this has been a 5-wave Elliott wave decline. This is your 3, 4, and this will be your wave 5. If it does accelerate much lower than 18,800, we'd probably start to see this as either a wave 3 or a wave C lower, which would imply that we are going a lot lower. So at this point of time, looking for a base case of a pullback into this 18,800 area, which may complete a wave 5 before another corrective wave higher. For the S&P 500, well, the situation is much the same. It just popped above the 200-day moving average. It didn't get anywhere near the broken uptrend from the Fed's pivot low back in October 2023, whereas the NASDAQ did. The NASDAQ popped above this level, but slightly different markets, slightly different characteristics. But in all instances, the 200-day moving average was sustained in terms of holding below there. A very brief pop higher, not convincing. It left a loss of momentum type candle here and then firmly back below. In terms of where it goes from here, well, I think if we are looking for some uncertainty in the lead up to this week and potentially a 15% reciprocal tariff rate, that should be enough to see the S&P push down towards this 5,400 level, which is the September low, the equivalent level of the NASDAQ at 18,800. So that would be my base case in terms of coming into this support region here. Again, if we were to see a sharper acceleration lower, and there is downside risk given the idea that we are seeing broader and faster rate of tariffs, then we would probably, instead of calling this a 1, 2, 3, 4 in an Elliott wave framework, and this being the wave 5, it probably is wave 1 or wave A, wave 2 or wave B, and then this would become wave 3 or wave C, which would bring us down towards this 5,000 area. This is not my base case. I'm just saying at this point in time, we're working with the probability that, yes, we do get new lows, and how much further it goes from this area here will determine whether this is a completed 5-wave decline before a corrective rally, or we're going to see the sell-off accelerate into April. Thank you for listening and have a good week ahead.